name is Jeremy Green, Director of Advanced Planning for CBS Brokerage. Today I'll be discussing trust-owned life insurance, part of a three-part series in which we discuss how closely held business owners who have federally taxable states go ahead and pay their estate taxes. Previously we discussed Graegin Loans and IRC Section 6166, and again today we'll be discussing trust-owned life insurance. So I want to discuss really how life insurance is used when it's generally owned off balance sheet to go ahead and pay the estate taxes. If it was directly directed towards paying the estate tax, it would be included in the gross estate. So it's owned inside an ILIT. It isn't directed, and nowhere does it say inside an ILIT to pay the estate tax with it. But inside, once the person passes away, the decedent or the insured, the death benefit's paid to the trust. The trust then exchanges by loan or sale with the estate for assets that it would transfer back. So like corporate stock, for example, illiquid corporate stock. In this example, I have a $10 million death benefit. The cash is paid out to the estate in exchange for this stock of $10 million. Then finally, the estate has the liquidity to go ahead and pay their estate tax liability. And at some point, the children or family or beneficiaries of that trust will eventually get that corporate stock, or may not. They may be held in trust for some extended period of time, depending on the jurisdiction and so forth. So, just so you're aware, even when you own life insurance in trust, even though it's not part of the gross estate, it must be reported on Schedule D to the extent that you actually had any life insurance on the insured. And in Schedule D, you report the death benefit, what kind of policy it was, and explain why it's not included in the gross estate. Now, these techniques don't necessarily compete with one another. They actually coordinate with one another, I would say. Life insurance allows us to do pre-planning. It leverages dollars during lifetime when possibly it's the best time to use some of that cash flow when the owner of the business might be still living. After the person's passed away, it may be harder to get a loan, for example. In the cash flow after death is where these other planning techniques are involved, IRC Section 6166 and Graegin Loans. Now, I will show you financially the difference between these techniques and how they play out. So if we go and compare these on a $10 million need, or whether it was a loan or death benefit, we're going to say, depends on the technique, for a term of 14 years, and I use a term of 14 years because IRC Section 6166 goes out for a term of up to 14 years. 4 years interest only, then the next 10 years after that, interest and principal. So I modeled a Graegin loan based on that 14-year period, and also a life insurance policy being essentially paid up, although not technically. Paid 14 premiums to have the death benefit go to age 105, for example. But let's look at the Graegin loan first. I assume a 6% interest rate for a commercial loan. That's actually relatively low. That's what you get for a small business administration loan, but let's just use that for now. A $10 million need after 14 years would produce $5,061,000 of interest, which would be deductible, assuming there was an actual liquidity need, would be deductible on the 706 as a miscellaneous deduction. So the net cost after the deduction for that loan is $13,037,000. If we did a IRC Section 6166, I assume a 2% fixed rate for a portion and 4% thereafter. It was called an underpayment rate without getting into the technicalities of how that all works. That's the way I designed it. And the cost of that after 14 years would be about $11,565,000. That interest is not deductible. That's the net cost against the Graegin loan. So $11,500,000 against $13 million. So the Section 6166 is about $1.5 million cheaper in this example, or less expensive. And then looking at life insurance, I assume that this instance is a 70-year-old male, 67-year-old female. We designed the policy to go to age 105 using 14 premiums and no more after that, under a 5.25% rate of return. That's the S&P 500 less dividends. And the reason why I use that is that we're using an indexed universal life policy, okay? And it's a very basic one without the inflators and so forth. So without getting into product much. But the point is, at the end of 14 years, the premiums on that is $3,335,000 is what you would have paid in. But there's an opportunity cost I factor into that too, because we assumed a 6% rate of cost over here, and I assume under modern portfolio theory, if you had a blended portfolio, a 60-40 allocation, a lot of advisors use 6% rate of return. So there's a cost of opportunity I add of $1.6 million to that. I add that back to the premiums. So really the cost is $5,030,000, okay, over that 14-year period. That's for a $10 million death benefit. That's far less than the cost of either one of these techniques. And if I wanted to solve, and I did, if I wanted to solve for how long it would take with a 6% opportunity cost to reach that 11 million or 13 million, it would take 23 years before the life insurance caught up to 11 million and 25 years at the 13. So that means you've reached age 95 for the male in this example. So life insurance obviously is a pretty effective technique. And it's not that you do one versus the other, you do one probably in combination with another. Because the life insurance is unlikely if you planned it today to cover all the estate tax needs into the future, even if you inflated that a little bit to accommodate for a future need. So if you enjoyed watching this video and have any cases where you have a business owner or federally taxable states you'd like to discuss, please look us up on the internet or email me directly or call me directly. Thank you so much for watching.